All right, everybody, welcome, welcome. So excited to be here. Another week of our CRE Playbook, your one-stop shop for deals, strategies, and tactics to level up your commercial real estate game. And today's guest is an incredible person, one that I admire, that I look up to, that has inspired me, that has taught me so much that I know. And Augie, I know you probably weren't expecting that intro, but truly, I do feel, I owe a lot of my current and future success to you. So again, thank you so much for being willing to be on this podcast. Thank you for taking some time to chat with us and help educate and share some of the knowledge that you have accumulated and that you shared with me. So thank you and welcome.
Yeah, I'd love to be here and excited to see you on your journey. And you're doing big things in the multifamily space. And I can't wait to see where it goes in the next 10 years.
Seriously. So, I want to back up. I want to get the story, how you got started in the real estate space, but for the folks that are on the line, I think one thing that is important to share is, how you and I met up, how we started working together on the front end. And man, that was, it seems like so long ago. I don't really remember. I think it was maybe close to 3 years ago now.
It's,
Um,
it was
it,
right 2020 or so, or 2021.
That's right. So, what was it? There was a project in South Seattle. One of our mutual friends or mutual connections introduced you and I, wanted me to be a project manager, and we flipped a home together.
Yeah, and it was a success. I mean, I think most people kind of expect to make maybe 30, 50 grand on a flip. And we were able to pull out about 150,000, which is astonishing considering the entry price was 467. So, it was a success, and I saw what you could do managing the system and taking it through the process with the investment strategy. And yeah, I think for our first project together, it was great. And, you know, as long as we can have successes like that, we're gonna do pretty good.
For sure. So, I think on that note, you said most people expect 30, $40,000. That was me. That was me before that project, right? I had done maybe it was half a dozen flips before that, and I was stoked about those 30, 40, $50,000 projects. Right? I was still working a corporate job. I was making a little bit of money, and it was great. Right? I was able to do this side hustle, make a couple extra. $100,000 a year additional just from, flipping homes. It was a lot of work, but, I think where I learned and really leveled up my game was that experience that I had with you, and really showing and well defining the investment strategy, well defining the scope of work, well defining the process of managing contractors. And that truly was the catalyst to leveling up my personal game. And I know that you've done have had a ton of speaking opportunities where you shared your secrets to success, and you've worked with other people, likely in a similar capacity, and again have helped so many people again level up their game. So, again, we thank you. And without continuing to um, shower you with compliments, I'd love to hear a little bit more about what it is and where you started. What do you do now, and where are you going next?
Yeah, and I think that's great because I've been doing this since 2007 is when I got into real estate in the mortgage space. I had a degree in finance. 2007 was when the market was collapsing. I couldn't get a job being a bookkeeper for $11 an hour, and so by necessity, I got into sales. I chose to be in mortgage because I was still using my financial knowledge, and I figured it would be something I could do with my schooling. And as I was doing mortgage, the market continued to be relatively low and dormant through 2008, 2009. But I noticed something while I was working in mortgage. I would work with these individuals who had rental portfolios, who had multifamily, who were doing investments. And at that time, a lot of the properties were worth less than the people owed on them. And that was a big concern. So what we saw is we saw lots of consumers actually letting their properties go into foreclosure because they didn't have equity and they didn't see the point in holding this asset. But what was interesting is my investor clients that had multiple properties, maybe they had $10 million of real estate and they owed 15 million on it. So they were negative $5 million on this real estate portfolio. But because of the basis, meaning the cost of that real estate when they got it was so low, they were still able to generate cash flow above and beyond the mortgage payment associated with that property. It was an interesting juxtaposition because you had these people who were coughing up their properties just because they didn't have value. And then you had these other people who were not concerned about the value of their property because they're collecting a paycheck every single month. It was at that time I used my financial brain and I said, there is no other product I am aware of that you can be negative on, meaning I owe more than the property is worth, but still be generating a return because I'm getting this positive cash flow. And that's when I realized real estate might be the best financial tool to actually do what I want to do in investing. All I need to do is make sure that the metrics meet for cash flow and or value. And if we do that, we can. Sorry about that. Looks like I cut out for a second.
There we go.
So yeah, so it looks like as long as you get the metrics correct with the cash flow and or the value, you are then able to make sure that your investment's good. So flash forward, I decided I want to get into investing. I started talking to my investor clients, seeing what they do, how they were doing it, what types of properties they were targeting. And in 2012, I met a builder through a lawyer, and we partnered on our very first project. We built townhomes. I got the bug immediately, kind of like most investors, and I kind of jumped in full-heartedly. At that time, I made a decision to think big. I came from a middle-class family. We didn't have a lot of assets. We didn't really have a lot of savings. Sorry, guys, I'm on my cell phone due to technical difficulties, and it looks like every time I get a call, it will flash out. I apologize. So I had seen that, what my parents had done, and I decided I only have really one shot. Either I am right with this real estate investment, I'm right with my analytics, and I'll be able to take that to grow millions of dollars in passive income, or I'll fail. And at that time, I had about $60,000, and $60,000 was not going to change my life at 26 or 25. And I decided to go ahead and roll the dice, put it into my projects, and move forward. We acquired that first townhome project. Within 3 months, I had acquired project 2. Within 3 months, I had acquired project 3. Those first projects were fantastic. The first one was 2 townhomes. We were able to double the whole basis of the project, which is about a 300% return on our cash. We were then able to roll the second project into a zero down transaction where we put no money, and actually were able to make 7 figures on that transaction. And then the third property, we developed an apartment building where we took a piece of land that was only about 3,600 square feet, and we built 8 units vertically on that site. And that project yielded about 1.25 million. And I was pretty shocked. I was like, okay, well, I've never done this before. I had a plan, I implemented that plan, and I executed. And over that first year of projects I purchased with my $60,000, I was able to generate roughly $2.7 million. So obviously I'm very young at this time. I'm very excited. I'm brash. And I just doubled down. So then I bought a 20-unit apartment site, built a 20-unit, expanded the portfolio from there, started buying development property all throughout Seattle, mainly for apartments and micro housing and single family properties, and continue to grow that portfolio and learn. As things went on, I learned another lesson that I think is very important for folks, which is after you implement your investment strategy. For instance, we bought a property, we renovated it, we maximized the rent to its fullest extent. At that time, we had taken the property through the total value add component. After that's completed, that property now has the maximum value, and the only additional return we're getting is market appreciation. So when I started analyzing one of my properties, I would tell people this. I'd say, I bought a property with zero down. I put 175 grand into it via debt, and then I still had zero down. And I have $1 million of equity that makes $4,000 per month. And I thought that was the coolest story I could ever tell anybody, right? But then I kept saying $1 million making $4,000 per month, and realized that my $1 million gain came from the initial investment activity. And all I'm getting from that point forward is $4,000 per month, which is about 4.8% return on my money. I then started to realize if I'm generating 300 to 1,000% return on some of these things, why would I ever hold that property, maintain that equity, if I'm not generating that same amount of return? So then I would liquidate some of these properties, reallocate that capital into new projects, and try to repeat that same process to grow quicker. So yeah, that brings us to today. And today we have lots of properties throughout Seattle. Currently, just to give you an idea of what we're working on, we're building 4 homes in Maple Leaf. We are starting a new construction in Madison Park. We are converting 2 triplexes into a 5-unit and a 4-unit. We're also breaking ground in the next 90 days on 4 townhomes in downtown Edmonds, as well as 14 townhomes in the next 6 months, also in downtown Edmonds. We're also doing a flip in Dadu, just finished a flip in Linwood, and I believe that is it. Oh, and I'm renovating my current home. So lots and lots of construction, lots and lots of development going on right now. And I think it's a fantastic time to be in that space.
That is a lot. Holy moly. So your first 3 deals did insanely well. I would say on any one of those deals is an incredible year for even an advanced investor, right? But to be able to nail all 3 down, is there anything specifically that you would, look to in terms of that made it such a successful project? Was it the upfront work in underwriting and making sure that it was a good deal? Was it the actual operations of it, working with your partner there? Was it the visioning? What's something that you would point to say that this was the true success? This is the reason that we were successful.
Great question. It's multifaceted, and I think that you hit the nail on the head with your first idea. Was it all comes down to underwriting. What I find most investors do is sometimes they'll get a little bit caught up in needing to buy something or wanting to get into the investment space. That's very much like our initial conversation about flippers flipping for 30 to 40,000.
Mm-hmm.
The problem with a lot of that is if you do that, you're not mitigating for risk. If the market were to come down like it did in 2022 or 2023, all of a sudden you've lost that money plus the money you've put in. So really stringent underwriting, and then not going outside of that. So if you set a profit margin of 25 or 30%, that gives you a big enough buffer where if something goes wrong or if there's unforeseen expenses, you're still going to make money. Or if there's a very catastrophic event like 2007, you're still at least going to get your principal back or be able to hold. So what we see a lot of people do is they will cut down on that margin and use things into their calculations, such as extreme appreciation, or maybe they'll use the highest comparable sales. One thing that we're very successful about is we decided we're going to use the average comparable sales for the product that we're going to build and sell, whether that's a multifamily or a house. So if the houses are selling for 1.75 on average, and the nicest houses are 1.85 and the cheapest are 1.65, what we do is we want to deliver a product that is high end of a finish or higher than the 1.85 million house, but make that work within our budget and our underwriting to sell at 1.75. That way we build in a little bit of a buffer on price in case there's a fluctuation in the market. And if the market
Hey, Augie, it sounds like your audio might be off. We're still off, Augie.
I apologize. This phone
Here we
is causing some issues.
Beautiful.
So yeah, so what I was gonna say is, yes, it all comes down to that underwriting. So what we would do is we would make sure that we delivered the highest product. So if that $1.85 million house had all quartzite countertops, all built-in appliances, et cetera, we'll deliver that product, but we're gonna price our exit value on the average product. So that way we know that if the market were to come down or if the market was difficult to sell, someone would choose our product over the next one, which guarantees we can liquidate. The number one thing that kills investors is if you get into a project and even if the market goes down, you can't liquidate that project. And so we want to make sure that we design our properties to get that maximum look or maximum yield That way we can afford to liquidate it even if we have to sell for a little bit less.
Makes sense. So there's two other points that I really wanted to touch on. We're talking here CRE Playbook about leveling up our game, going from maybe it's small multi or single family residential, or even small industrial to larger scale industrial. You mentioned one of the projects that you're working on is the two triplexes into a 4 and a 5-plex. Specifically on the 5-plex conversion, what's your process there? Is there any concern regarding the debt structure, the debt vehicle on that in that conversion, or is it a DSCR loan where it doesn't really matter?
So it does not really matter. There are funding types, and just so everyone knows, I'm also still a mortgage lender, and so we have access to all sorts of DSCR programs, alt QM programs, conventional financing. And what I tell people is there is always some sort of financing for what you're trying to do. And what our goal is to do is to start at the best level. So the acquisition of this property was with conventional financing because that happened to be the cheapest. The properties were not at a point that were cash flowing to allow for a good DSCR financing or commercial financing. We then increased the rents so that way the properties would be more valuable. From there, we're able to then bring on commercial debt as well as commercial renovation financing. And then based on wherever the market is rate-wise, that's what you're going to do. So in this particular time, we had conventional debt for the acquisition, and it was at a very low rate of 3.625%. So for additional funds to actually complete our additions of the units, which does cost a lot of money, we're actually taking out second position debt for that. While that might be higher, let's say 10.5%, the blend of the first position debt at 3.625 with the second position debt at 10.5%, it's going to blend to about 4.625%, which is lower than getting a brand new commercial construction financing. So depending on your specific situation and how you're going to finance something, there are multiple ways to look at it. And you don't want to get caught up in what the rate is, because sometimes that blended rate could be better if you're using a very high rate product for a small amount of debt, while you have a very low rate product on a big bulk of debt.
Brilliant. Yeah. So making sure that you're looking at all of your different options. I think, what people don't really realize quickly is that, what you can do from a debt perspective. Like you said, there's a financing vehicle for just about any scenario, just about any position you want to take. So really understanding, creating your business plan in advance, and working with the right people, mortgage brokers like yourself, and really crafting out and honing in that strategy and how you're going to take it on, and again, how you're going to get the best returns. That's great. I appreciate that. I think the next one was in terms of selling versus refinancing. I think that's certainly a thesis that I have adopted and have obviously learned from you is, once you've squeezed the berry and gotten all the juice, it's time to go find a new berry. Why, if you're able to still pull out as all of your original principal, I understand the idea of, tapping in and getting that equity. So it's return on equity instead of just a return on investment. Why not leave? And why not leave some of that cash or some of that equity in the deal, especially if you're fully cashed out?
Yeah, and so you bring up a great point. So we want to analyze each opportunity, and really what we have to look at in these cases is twofold. One, how much of that equity can we withdraw from the investment, right? So that might, for a lower end investor, you might be doing a primary residence where you can get up to 90% leverage. If you can get 90% leverage, pull the cash, don't sell, because if you sell, you have about 8% closing cost anyway. So at that point, you're only got about 2% equity in there you can't draw. That makes a lot of sense, because then you're not going to have a taxable event, and you can continue to experience that appreciation at a relatively risk-free level. If you are doing a project that's going to sell within a year and be ordinary income, that's another consideration. If you make over, $500,000 roughly, every dollar beyond that's going to be taxed at about 40%. So it might not make sense to sell a property if you're selling within that short period. So you have to look at how much equity can I draft, and what is my tax implication of this? And then are there tax strategies like a 1031 exchange, or maybe you could sell and purchase something in an opportunity zone or something that has a bonus depreciation that could offset that return. And those things will come into play as well. But what it really comes down to is if I did this project and I was able to generate $1 million on this project by taking it through A to Z within 24 months, right? Then I was able to, and maybe I put down 250,000 to do that. So for 250,000, I was able to generate a 400 or 500% return in this case, right? And I was able to do that in the first 2 years. After that, my return is only the rent and appreciation. So if that's, even if it's 9% cash on cash, or going to be 15% IRR, or whatever it's going to be over that period, what will happen is if you actually put it into an internal rate of return calculator, which internal rate of return calculates return based on the time frame you repay your capital from the investment. So you'll actually see that your IRR diminishes in deals where you have a heavy value add up front. So my philosophy is if I'm able to find these properties where we can make these big 200, 300% returns, and then we can complete that strategy in 24 months, at that time, I want to get that capital, even if there's a taxable event, so I can roll that capital back into projects that can do that 200, 300% return each time. What that's going to do is over time, it will keep my internal rate of return up. By doing that for roughly our first several projects, for maybe like the first 4 years, when you're smaller scale, you get a lot higher return because you're able to leverage more. We were getting roughly something like 84% internal rate of return on almost every project. As we've scaled and taking that larger capital across the board to bigger projects, we're still able to hit roughly anywhere between 30 to 60% internal rate of return, depending on the project. So that typically will exceed the amount of gain that we're going to get by continuing to hold that property for appreciation or cash flow.
Totally makes sense. Yeah, no, I think you're absolutely right. Repositioning capital. I think one thing to make mention is, understanding who you are as an investor is also important, right? For, folks like yourself being an incredibly active, this is essentially a full-time or secondary full-time job where this is, heavy on your focus, right? And so I think that, again, this podcast is largely geared towards that audience. But for the folks that, may not be necessarily as active, maybe they still got it, like you said, a W-2 job where they're still making $500,000 a year or maybe less. Again, realize where you're at, realize the amount of time that you can expend on something like this, and whether or not you want to continue focusing on building that, or if it's, again, cash flow and something more, a little bit more passive that you're looking for. And, I think, from an internal rate of return perspective, you're absolutely right. The velocity of money is so important, especially especially in the younger days in your investing career. So making sure that you're able to grow your money as quickly and as safely as possible is critical. So Augie, before we get into the triple threat, any quick advice or guidance to somebody who's looking to, again, scale from their first fourplex, scale from their first maybe small mom and pop sized self-storage facility, and take it into the mid-sized I would still say sub-institutional sized project?
Yes, I think that a lot of investors look at investment where the reason why we're investing is we have some sort of goal, like to retire or maybe get out of our profession that we might not fully enjoy. And so what I would tell all these people is while you're starting out, is very important to keep your income from your regular job. And the reason why that's important is because that's going to help you qualify. That's also going to help you cover your own expenses. So when you do complete a project, you're not taking your gain and then using that to pay for your vacations and housing. And if you can hold and maintain your job long enough, you will have to sacrifice on hours. As Carl said, I have 2 full-time jobs. I'm choosing to do that because it allows me to cover my expenses, and then all of my gains from my projects go towards my future goal of retirement, right?
Yep.
So keeping that income, making sure that you are working. Obviously, having some sort of flexible employment is great for that. So if you did transition to something that was remote or had the ability to move, that would be fine and actually help out. But have that income. And then secondary, take a look at your balance sheet. Where are my funds? Do I only have 100,000? Well, if I only have 100,000, that's not quite enough to really scale up and do big in our market. But I would still invest in our market because we have very good appreciation, we have very high buyers, and we have high asset values. If we have high asset values, we can make a lot of money. For instance, a DADU out there might make $200,000. If you only have 100 grand and you do a project that can raise 200 grand of capital, well, now you're going to have roughly $300,000 that you can invest in the next project and scale. So be mindful of where your capital is and what your capital situation is, and then invest in projects or opportunities that are going to allow you to fix your balance sheet. So if you need capital, you need to do projects that are going to get you capital. If you put 100 grand into a $100,000 property in Ohio, great. You're going to get $1,000 a month. Fantastic. And you're not going to be able to buy another property because you don't have more money. If you put $100,000 into even a flip in Seattle and you make 100 grand, you can make 100 grand in 1 year or even 6 months. Now you've doubled your capital and you can do it again. So it's important to understand where you're at, what your balance sheet looks like, and then invest in projects that are going to help you out. Or if you want to be truly passive, get in a syndication that's with an established operator who knows what they're doing. So you can passively participate in these investment strategies and get your money growing so you can ultimately double your money in several years.
Love it. That's great. Appreciate it. Thanks, Augie. Great advice. Now, last segment is Triple Threat, where we talk about physical, mental, and financial agility and what we're doing there in each space. Augie, would love for you to share what you're doing from a physical standpoint, what you're doing to stay fit. Stay fit.
Absolutely. So what I do is I do a weekly regimented task. If I do not have something that I do all the time with accountability, I won't do it. I have a very busy schedule working 2 full-time jobs. So Monday, Wednesday, Friday, every week for the past relatively 5 years, I have done personal training for about 45 minutes to an hour. Usually add on, some additional exercises before or after. On top of that, I've made a cognitive choice to be more active. So for instance, I work downtown Edmonds. I like to walk to lunch if I'm going to go do something, or I like to walk to go get coffee. So I get added exercise. And on top of that, I got a 3 and a 5-year-old. So I'm active all the time. I'm doing shoulder presses with the kids my daughter's only about 30 pounds, son's 60 pounds. So I got to do a little bit more weightlifting so I can get him up for the next couple of years. But, being active is really important, and it's transformed my life. A lot of your people who are seeing this don't know, but over the past 2 years, I've actually been able to lose about 170 pounds. And so being very active currently is my new goal. I'm very happy with my new life. And so doing that physical activity, making sure I work out, making sure that I'm constantly trying something is great. And then also eating healthy. I don't give diet advice because everybody's got a different body type. Everybody has different nutrients. What worked for me was just mainly switching to lots of veggies and meat, dairy, etc., and being very low on added sugars, any sugary drink, no soda, no nothing. And by eating clean, for me, my body accepts it very well, and it helps me feel better about working out as well.
Love it. Yeah. Once you get into that feedback circle of, you start eating healthy or you start working out, whichever comes first, it really starts feeding into the next one, because it's like, okay, I'm gonna eat healthy. I don't want to. I don't want to not work out because, hey, I'm already doing this particular activity, i.e., eating healthy. And then likewise, if you're working out, I'm not going to just go pig out on a bunch of junk food because, hey, I just spent an hour, running, or an hour doing this, that, or the other. And so it, again, is great feedback loop in terms of diet and exercise. So that's great. What do you do mentally? Reading podcasts, books. What do you do?
I'm a freak, man. I'm a robot. So like I'm just a numbers guy. My wife looks over and she's like, "Are you like calculating stuff in your head?" And I'm like, "Yes." I'm just sitting there crunching numbers, thinking through analysis of projects. I'll actually go through in my head and break out my net worth across my portfolio and back out sales expenses. And I go through all of these metrics. I'll rethink through our properties and reanalyze them in my head. I'll analyze properties I'm not even going to buy just because it will keep me sharp on what my clients are going to buy on the mortgage side. And by doing that, I keep my mind very fresh on numbers, math, etc. And I find that it helps me be very sharp.
I find you were the first person that I've seen actually have 10 of the calculators open on a computer at a time. And you knew exactly what each of those calculators do, right? Typically, I just open up Excel and I just have a running Excel sheet for that type of calculation. You are cranking out these calculators. I actually had no idea you can open up multiple calculators on a desktop. So I
Yeah.
learned that from you a couple of years ago.
Yeah. A lot of times I see myself when I'm doing this and I'm like, I should really just build out an Excel. But then like I have the MS calculators up and I'm just like, all right, this one's got that part of the formula,
Yep.
plug and play. And I do all the algebra. It's crazy.
Love it. Love it. Retirement, financial. What are you designing? What's your end goal? Do you have one?
Yeah, so the tech kids always like to label things. So the tech kids have now called it FIRE, Financial Independence, Retire Early. That is my goal. I'm 39 years old. I envision my life where I have enough income to cover my entire lifestyle that I have today. I don't want to live less. I want to live more. I also want that level of income to generate future wealth. So I wanted to generate my income plus continue to grow my wealth. The reason why is I'm mitigating risk. I want to make sure that if the market were to come down or inflation were to go up, that I would continue to be able to live my lifestyle in perpetuity.
Love it.
So I define that very easily. Instead of an exact dollar figure, I'll define it as a formula. So what I like to do is I like to do my highest expense year. So I'll do the math for you. If my highest expense year was 100 grand and I was happy with my life, then I'm gonna multiply that by 2. That's gonna be $200,000. Okay. If I have 200,000, I'm then going to multiply that by 25. All right. That's just going to come up with a total net worth that you need, which is going to be, if I could get my calculator to work here as we're talking about calculators.
To 4.5 million.
Yeah, 4.5 million. So if you have 4.5 million, and then you're assuming a 5% return on your money, which could be something like a low rate of S&P return or a very generic cap rate of a property. That 5% is something that you should be able to get completely passive without any engagement. What that is that is going to give you your 100 grand that was your most expensive year plus additional growth into the future of that same. And when you feel like pulling into it, like if you wanted to go take a yacht trip or something, you can take from that instead of relying on the income you're using to maintain your lifestyle. So again, it's going to be your highest expense year times 2 times 25. And if you hit that number, retire. There's no point having more money than you need. And realistically, over time, the market's going to do its thing. If you hit that number, your money's just going to keep growing in perpetuity. So just be happy, enjoy life.
Love it. 2 times 2 times 25. I'll remember that.
All right.
Good stuff, Augie. Well, I appreciate your time. Any last words before we adjourn?
Just be careful, guys. Make sure you actually do your numbers. If you are investing with people, make sure that you see what their projects have done. Make sure that you actually talk to people who have invested with them to see what that was like. And make sure that you get a second opinion from someone like Carl or myself who knows real estate. That way we can tell you if it passes a sniff test. There's a lot of people out there who say they do real estate, but believe it or not, they're not actually generating returns. And while there are massive opportunities for gains in real estate, which I'm happy to share with you, there's also opportunity for loss if it's not done correct. So be careful, be safe, but definitely get involved because this is one of the last ways for you to actually increase your wealth and grow positively.
Love it. Beautiful. Augie, thank you so much. Thank you, everybody. This has been an incredible journey today on the CRE Playbook. Look forward to talking to you next week. Augie, thank you again. Great chatting.
Have a nice day, Carl.
Take care.